morning, everybody. Time for our chart of the week. And this week we're going to be focusing on the volatility index, or the VIX. Many people call it the fear index. So it's been on the rise, certainly since the beginning part of December, but not very many people have really noticed it until more recently. So let's chart this up and see what we can figure out. So what caught my eye here is this stretch of higher lows and higher highs in the VIX over the past 4.5, almost 5 months since the beginning of December. And you can see that it's a little bit of a sloppy channel that I put in there, but it's got rising bottoms and it's got rising tops, right? And we did break through that lower end of the channel in the end of March, but bounced right back above it. And then we see the move that happened just these past few days. Huge surge in the VIX, closing above 17, and then on Monday, April 15th, we saw a big surge up through 19, and we're still above that 19 level right now. So as it is, the VIX is a little bit overbought right now, and you can see that with the RSI ticking above 70%. Last couple of times it went up to this area was a bit of a peak, so we could pull back down. But the one thing I want to isolate on here is the impending merging of the 20 and the 200-day moving average. So if you look closely here, you can see the 20-day moving average is this dotted line, right? We put this dotted line in there, we plot that in there. This dark line over here is the 200-day moving average. Now, for a good majority of this last rally, the 20-day moving average has been below the 200-day moving average, and that indicates a bullish condition for the markets, right? And we got that crossover here at the towards the end of November, and we can see in kind the VIX kept coming down, and it went down all the way to well, actually it was over just under 12% for a little while in December, showing a lot of complacency in the market. But now we have this 20-day moving average threatening to cross the 200-day moving average. Now let's see what happened last time that occurred, right? So we were up here at the middle part of October, and that's when we set those October lows. We can remember that this move up into the mid-20s from the high 17 area was a pretty vicious drop in the markets from here to there, and it was about a 40% increase in volatility, and the markets went down quite sharply. So when volatility is up, it's spiking like it is right now, we're going to see a lot of volatility. Now, what does volatility mean? It simply means that ranges are expanding, right? Instead of seeing the markets go like this, it's going like this, right? Up and down, big time. So that makes people a little bit uneasy about being invested in the markets. We know that a lot of people are pulling money out of the market right now because interest rates are elevated, and they seem to be climbing every single day. 10-year yield above 4.6%. We see people reaching for some protection here, and we can see it evident in the rise in the volatility index. So keep an eye on the VIX over here. At some point in time, it's going to spike up and come right back down, much like it did in middle of February. We can see a big spike over here and came right back down. I think a lot of people were expecting that after Thursday. We spiked up and came back down, but then we came right back up again on Friday with news of an attack in the Middle East. And then yesterday, of course, we tried to come back down, and we couldn't even get through that this channel over here, and we closed near the highs of the session on the VIX. So keep an eye on the VIX. It's an important indicator for us to pay attention to what the market is thinking at any moment in time. So it's volatility index. Thanks very much for watching, everyone, and I'll see you guys next.